Good evening everybody, thank you very much for joining in. Today we're going to speak about a topic which is known as option Greeks. Well, we all know that we had a lot of word about option. What do you mean by an option? It is a derivative contract which will give you a right to sell or buy rather than having an obligation. Option play a very important role in the world of corporate treasury nowadays, considering the fact that currencies are moving here and there anytime. We have 1 year volatility of majority of the currencies which are trading roughly at 9.5%. From this side, I am Rahul Magan, working as a corporate treasurer in EXL Services India and also acting as a treasury trainer and business consultant for various firms across the world, predominantly in Singapore. Also acting as a virtual treasurer for various companies in India. You are most welcome to join my Foreign Exchange Academy, which is Foreign Exchange Every Thinker, which is on LinkedIn, which covers 2,200 global members, which is on YouTube, 52 technical videos, 1,280 subscriber views and roughly 45 subscribers. It's also on Daily Motion, which is 35 technical videos, and also the newly created page on the Facebook, which is Foreign Exchange Living Thinkers. You're welcome to contact me at 9899242978 and also at rahulmagan8@gmail.com. Before to start, I would like to stress the fact that today we're going to speak about one of the most beautiful topic, which is known as option Greeks. What do you mean by an option? Option is having a right but not an obligation to either buy or sell. Option can be categorized into two parts. One is known as call option and another is known as put option. Call option and push or put option can further be divided into two parts. One is known as buy call, another is known as sell call. In put option also, one is known as buy call, another is known as sell call. Once we link both call and put, then this is known as option payoffs, like range forwards, like Seagull, like call spread, like put spread and all. However, what's a basically what do you mean by option Greeks? Options are an instrument which can further be hedged. What do you mean by option Greeks? Option Greeks are those financial instruments or those financial techniques which will help you to take a further projections on your portfolio which is based upon an option. Or option Greeks will let you know where your option is going. That is one of the reasons why it is also known as a derivative contract. However, in the case of forward contract, there is no Greeks. You buy and sell at a predetermined rate which you cannot hedge. Basically, you've taken a forward contract, you had hedged yourself. Now where the currency would go, you will park the M2M. That depends which hedge accounting you are using. In the case of option contracts, a treasury which is acting as a profit center is able to hedge further options, and that they will do on option Greeks. Before to start, I would like to state the fact that we are going to cover a lot, very good insight of the option Greeks, but may not be a very detailed insight of the option Greeks. The detailed insight of the option Greeks would come in the next videos. Option Greeks are of four types. Let me rub this. Option Greeks are predominantly into considered as four, which is known as delta, which is known as gamma, which is known as theta, which is known as vega. What do you mean by delta? Delta refers to change in option price to change in underlying. Underlying could be a stock, could be anything. Delta lies between -1 and 1. Delta for call is always greater than 1. Delta for put is always less than 1. Now this is the mathematics pertaining to delta. Delta for call is greater than 1, delta for put is less than 1. Delta for in the money, I would refer deep in the money, is equals to 1. Delta for at the money is equals to 0.5. Delta for out of the money is always 0. And delta always lies between -1, I will treat it 0 to 1. This is what delta. Delta is the first derivative. Delta will tell you that the change in the option price to the change in the underlying. The underlying could be your foreign currency, underlying could be your stock, could be anything. Gamma is the derivative of delta, because the change in the currency, change in the stock, change in the underlying may not be linear. Henceforth, it is predominantly important for you to have the second derivative as well. Now, gamma tell you change in delta to change in gamma. Gamma is pretty strong for at the money option. This is about moneyness. Now please be note that the speed in which, if you have out of the money option where delta is 0 and the option is turning out to be in the money due to the sudden change in the volatility, then that doesn't mean that the gamma will move in the same way. Gamma would always have a less speed versus delta. So if the delta of any option would go strong, the gamma of the option would not go at that pace at which delta is going. However, why gamma is using? Because of the non-linear payoff. Please be note that every time currency, stock, commodity, oil, gas, gold, platinum, diamond, anything will not go in a linear payoff. So to have a non-linear kind of thing, to have the valuation of the non-linear, you need a gamma or a second derivative, which is known as change in delta to the change in time. Third refers to theta. Theta refers to change in time theta refers to change in option price. Here is a small change. Gamma is nothing but change in delta to change in underlying. Theta is change in option price to change in time. Theta is also refers to as a time decay. Please be note that time decay is always exponential in nature. Time decay would be very fast in the last 30 to 45 days of option expiration, and it would be very slow. So all the front end months would face exponential time decay. On the other hand, all the back end months would face linear time decay. Theta would refers to as a time decay. Theta supports sellers. So here I am writing theta supports sellers and theta go against buyers. They support sellers that because as the time passes, seller would turn into a situation wherein the buyer won't exercise the option and they would get the premium. Theta supports the sellers. On the other hand, theta will go against the buyers. Fourth refers to Vega. This is one of the most important concepts, and we are going to make a separate video, the upcoming video on Vega. However, simplistic reason, Vega would be refers to as the implied volatility. Now, Vega means change in implied vols. Sorry, it is change in option price to change in implied vols. Before to concentrate on implied vols, I would like to re-stress the fact that the Greeks, basically there is one more Greek which is PHI as well. The first is delta, change in option price to the change in underlying. Second is gamma, which is change in delta to change in underlying. Delta is always between -1 to 1. Delta for call is greater than 1. Delta for put is less than 1. Delta for in the money option is equals to 1. Delta for at the money is 0.5. Delta for out of the money is 0. If any out of the money will go in the money, then in that sense delta will move with a very fast pace. However, gamma may not be able to move at a very fast pace. Then you have a theta. Theta refers to change in option price to change in time. Theta would also refers to as a time decay. Now please be note that theta support the sellers but not the buyers. So they always support the sellers but not the buyer or not the buyers. Then you have the implied, then you have a Vega. Vega means implied volatility. Change in option price to change in implied vols. Volatility sometimes refers to as the vols as well. However, before explaining the Vega, let me introduce you to the concept of volatility. Volatility is nothing but a swing in prices. I am referring to a term swing in prices. Swing could be both positive side, could be negative side, or could be sideways. So volatility could be two types. One which is ranged, can be referred as a sideways. Other refers to swing in prices, positive swing in prices and negative swing in prices. Volatility can be of three types. One is known as realized volatility. Another refers to as a historical volatility. And another refers to as the implied volatility. Implied volatility sometimes refers to as the IB as well. Realized volatility is nothing but a cut short version of historical volatility. Historical volatility could be of 10 years, 5 years, 50 years, 20 years, any. The cut short version of a historical volatility is refers to as realized volatility. Implied volatility refers to a volatility which a trader would foresee. What would happen? I want to price the call and put option considering the volatility 10%. Today volatility may be 9.8%, 11%, 12%, but he want to price at a certain rate. So this is at which he is going to price. Implied volatility is nothing but the volatility which traders are generally calculating on out of the money options or at the money options, but that again vary from trader to trader. But on Vega is always computed on the implied volatility. It may be possible that in countries like India sometimes options may also getting priced on historical volatility or a realized volatility, because option market is little vague. You have one FIDI cut wherein they are giving a range of volatility which traders are using. So there is no standard volatility which you have on Reuters which you can use. But standardly worldwide you have Vega which is priced on implied volatility, and implied volatility is the volatility which traders are pricing. Basically they see that this is the kind of volatility they see for a respective stock or a currency. These all about the Greeks. You have one more Greek which is known as PHI and RHO. These all about PHI and RHO are nothing difficult, which is known as change in option price to change in interest rate. Now at last I would like to stress the fact that the three biggest Greeks for any option trader is your delta, is your Vega, and is your gamma. These are the three biggest Greeks for any trader. Sometimes traders consider time decay as well if they are taking a front end call. Front end call refers to if you are taking a 6 months option. If the option is for 6 months, then you are taking it just 45 days to left, and this would be a front end call. Front end call means near months. Late end call or the far end call would be the far months. Please be note that option Greeks play a very critical role in terms of hedging of option contract, and wherein the volatility play a very important role. You should understand the fact that when volatility high, you should not buy an option contract because you end up paying more premium. You should always always have an option contract when volatility is low, and always sell an option contract when vols are high. So simplistically speaking, buy when vols are low, sell when vols are high. This is all about option Greeks. The upcoming videos we are going to discuss each and every Greek in detail, but as of now this is just an introduction to the option Greeks. These option Greeks people are using to hedge their portfolio, which may not be possible in the forward contract. You're most welcome to contact me at 919899242978, and also welcome to email me at rahulmagan8@gmail.com. But before closing the video, I would like to stress the fact that options play a very critical role for any corporate treasurer. They should not hedge their receivables and payables using forward contract. Rather, they try and hedge using option contract. Thank you.